Today, we are diving deep into a company that I think is sitting right at the center of India's massive digital revolution. It's called Techno Electric, and it might just be one of the most important companies you haven't been watching closely. So let's get into it.
So let's set the stage. What's the situation on the ground? Well, you have to understand, India isn't just tweaking its power grid, it's in the middle of a complete ground-up rebuild. We're talking about a national mission that's going to span decades, all to power up everything from green energy to the digital economy. This is not some short-term trend, folks. It's a fundamental, structural shift happening right now.
Okay, so where does a company like Techno Electric actually fit into this massive picture? Well, they're not just your average construction company pouring concrete. Think of them more like high-tech grid architects. They build the substations that keep the grid stable. They install these super advanced systems called STATCOMs to handle the tricky voltage from renewable energy. And, most critically, they provide the absolutely essential zero-downtime power that data centers need to survive. These aren't just nice-to-haves. They are the mission-critical systems that our entire digital world runs on.
And that right there, that brings us to the core opportunity, the big idea. Techno Electric is building the invisible backbone of India's digital future. Burn that phrase into your mind, because it's the key that connects their really complex engineering work to the explosive, mind-boggling growth of data centers and the entire digital world.
All right, so if this opportunity is so huge and so obvious, where's the conflict? What's the catch? Well, the conflict lies in a giant gap in perception, a blind spot. The market is looking one way, while the reality is somewhere else entirely. And that, my friends, is where an opportunity is born. This slide just lays it all out, plain and simple. On the left, you've got what the market sees, just another old-school power EPC company. You know, a boring, low-margin, high-risk construction business. But the reality, on the right, it's a completely different animal. It's a high-tech integrator for the new digital grid and, crucially, for data centers. This gap between perception and reality, that's the valuation blind spot we're talking about.
So that leads to a really important question, right? What is that one big, scary thing about this entire industry that keeps most investors away, that keeps them stuck in that old-school mindset?
And here's your answer. It's called working capital decay. It is the silent killer of profits in this business. See, a company can announce massive new projects, but if their cash gets stuck, tied up in unpaid bills from clients or endless project delays, then the profits they show on paper never, ever turn into actual cash in the bank. It's that quiet bleeding we talked about right at the beginning, a real wealth destroyer. Now, here's a little secret, a pattern interrupt for you. Most investors don't realize this, but Techno Electric's true competitive advantage, their real moat, it isn't about winning the biggest contracts. It's actually about having the discipline to say no, to walk away from bad projects with risky clients or terrible payment terms. That discipline is their shield. It's what protects them from that silent killer, that working capital trap. Okay, so now it's time for action. Let's put this company through a financial litmus test. This is where we stop talking about the story and start looking at the hard data to see if this story of discipline and evolution actually holds up. We're going to prove that the market's view is lagging way behind the reality. But before we jump into the numbers, I want you to remember one thing. Forget the headline revenue number. Revenue growth can be a total trap in this industry. What we really need to look at is the quality of the earnings. Is this growth actually profitable? Is it efficient? And, the million-dollar question, is it turning into cold, hard cash? First up, let's talk valuation. Now, this is not a tiny company. It's got a solid market cap. But just look at its price-to-earnings ratio. This chart shows you that its P/E is actually lower than the industry average. What does that mean in simple terms? It suggests the market is undervaluing the company, probably because it's still seeing it as that old-school EPC player. You're basically getting more bang for your buck, more earnings power for your dollar, compared to its peers. This is that valuation blind spot, shown in plain numbers.
Okay, this slide is like the company's report card. It shows us how good they are at creating wealth. Both return on equity and return on capital employed are on the rise. That tells you management is getting better and better at turning every single rupee of capital into real profit. And look at those margins. They're improving. This is the proof that they aren't just growing. They're growing more profitably, especially as they make that smart pivot into those high-margin data center projects.
And you can see that smart, profitable growth right here. This chart shows the growth rates for sales, profit, and the stock price over the last 3 years. But here's the magic trick, the thing you have to see. Profit growth is actually growing faster than sales growth. That is a massive green flag. It's proof that those improving margins we just saw are hitting the bottom line hard.
But again, let me say it again, none of this matters if it's just numbers on a spreadsheet. Growth is absolutely 100% meaningless if the company isn't collecting the cash. This brings us right back to that silent killer we talked about, working capital. And this, right here, is the ultimate test. I call it the honesty test. We're comparing their reported profits to the actual cash flow from operations. In this business, you need to see that cash bar tracking the profit bar over time. That's how you know the profits are real and not just some accounting fantasy. A big gap is a huge red flag, but what we see here is a healthy conversion. It confirms their earnings are backed by real cash. Now, let's look at their defense system, a debt-to-equity ratio of practically zero. Being debt-free gives them a fortress balance sheet. It's a shock absorber that lets them ride out any storm, and, more importantly, gives them the power to walk away from those bad projects without some banker breathing down their neck. This financial strength is a massive, massive competitive advantage.
So finally, who actually owns this company? Well, the promoters, the founders and their family, hold around 57%. They have serious skin in the game. What this means is their personal wealth is completely tied to the long-term success of the business, not just hitting some quarterly target. That high promoter stake creates a powerful alignment between management and long-term shareholders like you and me.
So, after putting the company through this whole financial gauntlet, we finally arrive at the resolution. We can now pull all these threads together and build a really clear, actionable thesis about what's going on here. So here it is, the entire investment case in 3 simple, powerful steps. First, you have these massive multi-decade sector tailwinds from India's grid and digital transformation. Second, you have a mispriced evolution, where the market just hasn't woken up to the fact that this isn't an old construction company anymore. And third, you have the proof of disciplined execution, which we just saw in their strong balance sheet and solid cash flows. So why is this so important right now? Well, because you have this perfect storm brewing. Their strategic shift into high-margin data centers is picking up speed. Their capital efficiency, that ROCE number, is getting better and better. And the valuation? The valuation is still lagging behind this new reality. This is that window of opportunity, where the story is starting to show up in the numbers, but it's not fully baked into the stock price yet.
And it all comes back to our big idea. Remember this. You are not just looking at a power company. You are looking at the invisible backbone of India's digital future, the critical plumbing that makes the entire modern economy work.
And that really just leaves us with this one final thought. When you look at all the evidence, the scale of the opportunity, and the national importance of what they're building, you start to realize this is not a stock, this is infrastructure of India's future.